Well, let's welcome on board Nilesh Shah from Envision Capital and find out what he's making of the market right now. Nilesh, hi, good morning. Hope everything's safe and sound with you as well as your near and dear ones. Just wanted to understand, Nilesh, with Monday's reaction in the market, are we done penciling in the damage with statewide lockdowns? So do you think the situation for the markets could worsen with the worsening COVID-19 situation?
Aisha, good morning, and wishing you and the team at ET now the best of wishes. Well, it looks like, we saw a knee-jerk reaction on Monday to basically the looming second wave. And as the second wave basically, in a way, acquires a larger proportion and acquires a more pan-India kind of a dimension, you would see these concerns still kind of, in a way, linger on. But the good news is that from essentially the highest levels in the government, there have been statements which say that we are not going to see a national lockdown, and it's going to be more limited to local pockets. And that, I think, is very heartening. So the kind of damage that we saw in 2020 to basically the economy and the businesses, that's unlikely to repeat itself. There could be some bit of a pause in terms of demand as economic activity ebbs a little for maybe a few days or a few weeks. But probably a month and a half from now, things should be pretty much normal. So I probably think that the markets are going to be a lot less concerned about basically the second wave than what it is made out to be. And therefore, we remain extremely constructive in terms of the growth for rest of the financial year and even beyond, and even in terms of the market outlook, we remain extremely constructive and positive.
Nilesh, you track the IT sector pretty closely, and I was just looking at the weakness in the entire IT sector dragged down by Infosys, and on Tuesday it was TCS. What in the earnings is so disappointing, or was it the case that the stocks already made fresh 52-week highs ahead of the numbers?
Well, a couple of things. From a pure fundamental and a business point of view, the sequential growth was not as strong as what it was made out to be. And we've also seen a strong surge in the stock prices, and where valuations are north of 30 times, which optically seem to be on the higher side for a business which is probably going to grow at maybe 10-12%, a combination of maybe 8 to 10% top line growth and maybe margins holding on. You probably see overall earnings grow at about 10 to 12% from a couple of years of perspective. And that is the challenge, that for a 10 to 12% growth business, do you pay kind of a 30-35 times earnings, especially when growth is kind of coming back with fair bit of vengeance in some of the other domestic facing businesses. And that clearly is going to be some kind of a headwind for the technology services sector. So I wouldn't be unduly concerned about the way markets are reacting right now to technology stocks. And this correction could still probably continue for another 5 to 10% levels as well. But probably maybe 5 to 10% lower from now. Again, I think the large cap IT services companies, the large cap technology services companies would present again a good investment opportunity again from a couple of years of perspective. So I'd probably say that it's more about valuation multiples getting adjusted and beginning to kind of price in slightly more sedate relative growth and nothing beyond that right now.
Hi Nilesh, good to have you back. Not been able to connect with you as much as we did because of the lockdown, but so nice to connect with you on this digital forum now. Nilesh, have you liked anything from the recent IPO space? Very interesting IPOs have gone public. A travel company, a gaming company, a real estate company.
Nicholas, thanks for the warm welcome. And clearly from the recent IPO stable, of course, for most of the IPOs, what we've seen basically is that, the prices have in a way climbed further post-listing. So the IPO price itself has been kind of not very attractive, and post that we've seen some real relative strength for several of these freshly listed IPOs. So we're watching this space. Of course, the challenge in the gaming space is that they don't make profits right now. So essentially for us, that becomes essentially a no-go area. One business that we're liking and we're a little excited about is basically Mrs. Bector. That's basically a position that we own, which we've bought post listing. When post listing it kind of came off and had a more kind of a sedate price movement, but we like the opportunity, especially for its positioning within the bakery segment, the breads and the buns segment, and we clearly believe that with the growth of QSRs and as India and the younger population in India becomes more a bread consuming kind of a segment, we think that the long-term growth prospects for a business like that look extremely appealing and extremely compelling. So we like that within the recent IPO stable.
Nilesh, I want to go back to this whole thesis of IT. Now, IT companies, and I'm keeping FY22 aside, that's the year of a wacky base. You will get a double-digit growth because of last year's base. But markets are now focusing on FY23 and FY24. If I look at large cap IT stocks, Nilesh, 10 to 12% growth with margins of 22 to 25% depending on the company you are choosing, and P multiple on an average of about 20 to 30 times depending on the stock you're choosing. So my friend, where is the scope for returns now? A sector which is growing at 10-12% is already trading at 25 times plus.
Yeah, so what I will do is I'll just probably pick, say for example, the larger company out here, say Infosys, which just announced its results. And if I were to kind of bake in the kind of guidance which Infosys has given for FY22, and on that further built in basically something like a kind of a 12 to 13% earnings growth, even for FY23. So basically between FY22 and FY23, we talk of basically low teens kind of earnings growth. So if we have that kind of a situation, Infosys will probably exit FY23 with close to about 60 times earnings. And if you 60 EPS, sorry. So 60 EPS, and even if you basically were to give it a 30p multiple, which it is currently trading at, you probably kind of get to a price of about closer to 1,800 rupees a share. So probably around the levels of 1,200, 1,250 should be a good entry point with somebody looking at a 2-year kind of a horizon and basically aspiring to kind of get returns of like high teens from a blue chip bellwether like Infosys. So that's probably the thing. So I probably think is that from a 2-year perspective, be it TCS, be it Infosys, probably bake in essentially a earnings growth which is in the low teens, and basically valuations which are more like around 30 times. And that's where you would basically kind of get to. Now, even if, of course, earnings expand from, if the multiples expand beyond 30 times, of course, which they have done over the last year, obviously you could probably end up with slightly better returns. If the multiples do not sustain in terms of where they have been over the last maybe 6 months, and even in a way climb down a bit, you'd still be fine. Probably you'll end up making slightly lower returns, but it would still be a relatively attractive kind of a proposition. So clearly, yes, in the very short term, the sector definitely is going to have headwinds in terms of price performance, stock price performance, given the kind of heady performance they've had. Margin headwinds will continue because last year was a phenomenal year in terms of margins. Those margins will obviously are unlikely to sustain as they go in for wage hikes. But overall, still, these are going to be cash flow generating machines. Their need to invest back into the business, especially on organic growth, is going to be limited as basically remote working, work from home still is essentially the order of the day. So to that extent, their ability to return cash to shareholders is going to be still very high. Capital efficiency is going to remain strong. So overall, I don't think the investment thesis for technology services companies in India has changed in any way, in any material manner. It's just that the valuations have turned a bit heady. If the prices do correct, I still believe that it will again present a medium-term compounding opportunity.
Okay. You know, there's one stock which I must share with the viewers, which Nilesh has got it right, and you know that has really created a lot of wealth for his investors. That's Tata Elxsi. I'll request my producer to, let's say, fire in the 3-year chart or a 5-year chart. I mean, take Tata Elxsi anywhere from anywhere, and you will see a big marked outperformance in that stable. But Nilesh, you know, you don't make money by looking at yesterday's growth. So no Tata Elxsi, great investment. I'm sure everybody has benefited, including our viewers and your investors. The next theme, Nilesh, from a market standpoint, is this entire migration towards EV or clean energy. Some companies are migrating towards solar, some companies are migrating towards gas. How are you taking or how are you building portfolios? Because in this decade, I personally feel that the way we've consumed energy is going to change. Are you putting your bets anywhere?
Well, we obviously watching this space very closely, and I agree with you that it's a fantastic opportunity. I clearly believe it's a very, very strong and a compelling investment theme. And the way we're really looking at it essentially is to kind of look out for companies which are, on one hand, positioning themselves for the bioethanol kind of space, the biofuels and the bioethanol space. And then what we're evaluating are basically companies which are playing a very constructive role in helping producers build their ethanol manufacturing kind of capabilities. So that's a space which we find more exciting, because that's probably a more asset light and a capital efficient way to kind of play that theme. Of course, the conventional renewable energy space, which is basically solar, wind, etc., has had its own share of challenges in the past, and we don't think that headwinds for them have in any way come down, because obviously they continue to be very asset heavy and very capital heavy kind of businesses. So we really believe that maybe ethanol is kind of looking to be a very, very kind of an interesting opportunity going forward. And of course, engineering companies, EPC companies, which are helping some of these players to build their capacity, I clearly believe that that's a relatively more attractive opportunity. I also believe that there's been a lot of clarity which is coming from the government, a lot of incentives which are really coming from government. A lot of targets in terms of the blending targets have got, in a way, pretty much preponed or fast forwarded. So to that extent, I believe that that's a extremely kind of an attractive opportunity.
Nilesh, hi there. Good morning. Being a pandemic hit year, a black swan event, what do you think should be the prudent asset allocation strategy? Has that changed for you since the last year in terms of, allocation to equity, debt, say gold, real estate as well?
Nothing has changed materially. I still believe that clearly, equities essentially is the way forward, especially in context of the way the returns which are there on the fixed income side, and the kind of yields that investors can get on fixed deposits and some of the other comparable instruments. Versus that, I strongly believe that for domestic savers, domestic investors, it still continues to be equity which should be the way forward, and equities should essentially be at the forefront of a disproportionate asset allocation as far as domestic savers and domestic investors go, because probably it's one asset class which probably will have the ability to beat inflation and probably offer some kind of double-digit returns over the medium to long term. So I still believe that we like Indian equities. We clearly believe that corporate earnings growth is back and is likely to get stronger over the next 2-3 years. Several reforms of the government are likely to take shape. It's unleashing the animal spirits of businesses and enterprises to grow and expand. And all of this, in a way, is likely to kind of sustain a very benign and a very virtuous kind of earning cycle, and which is likely to end up being rewarding for investors over the medium to long term.
Okay. And within, looking at the kind of commodity price rise that is impacting sectors across the board, the inflation conundrum as well, how is it that you would play sectors that are very closely linked to this?
Well, the best way to really do it, of course, is to play these sectors directly. And of course, if you think that commodities, essentially the upward spiral in commodity prices is likely to sustain, you could directly own some of the producers of these commodities. But that's not the way we've been looking at it. We've essentially been looking at those kind of businesses which are ancillary or adjacent to these kind of businesses which benefit because of these surging commodity prices, because of better demand, better offtake. So be it makers of ancillary products, component products, consumables to steel, cement, and some of the other core sectors. So we've been playing it that way by owning some of the businesses around refactories and things of that kind. So we've been playing it that way. The other way to kind of play it is to kind of look at saying, okay, if you bullish on, say, copper prices going up, how do you play it? And therefore, we think that the makers of wires and cables, so companies like Polycap, which we own, obviously are currently still demonstrating pricing power and pricing flexibility, and they would tend to basically benefit from these kind of businesses. That's the way we've been really playing this whole surge in commodity prices. And I think we think that this is a relatively more capital efficient way to basically participate in the commodity boom that we're seeing globally.
From here, Nilesh, given the kind of uncertainty with regards to, the COVID-19 situation in the country and across the globe pretty much, do you think the move from here in the market is going to be market cap agnostic, much unlike what we saw in 2020 play out, wherein you had a big large cap led rebound and a very sectoral nature at that as well? Do you think from now on the tilt could be perhaps more towards small and mid caps and very individual stock by stock led story?
Yeah, absolutely. Clearly believe that, as this uptrend kind of in a way marches forward, and as the bull market gets even stronger and stronger, clearly believe that some of the mid and small cap companies will essentially benefit disproportionately. And I clearly believe that space has the potential to do way better and outperform some of the large caps as well. And that's because some of these mid and small caps have interesting business models. And in an environment of a very broad-based economic recovery, spanning across both the consumption and the investment cycle, as well as some of the export-led businesses, a combination of these three things firing together creates a wonderful opportunity set for some of the mid and small cap companies. Of course, these companies also benefit from lower interest rates as their cost of capital comes down, and therefore they in a way are in a position to expand their margins. So I think on the whole, strong tailwinds of economic growth and tailwinds coming in from lower interest rates, we believe that that's something which places the mid and small cap companies in a relatively advantageous position versus some of their large cap peers.
Sure. Nilesh, what one saw in the rebound and revival which took place earlier in 2020 post the national lockdown getting lifted is that the rural theme came to the fore. If I just look at the price action on Tuesday, and I don't want you to comment on the same, but just for the benefit of our viewers, you had an M&M which surged 7%. Today I can see Dabur hold out. You think the texture of the market is again going to have the rural tilt, or will the market behave a lot differently now, considering these are well-discovered stories?
Well, the rural tilt and the rural bent, I clearly believe is a very sustainable opportunity. And that's because agri incomes are pretty strong. The rural side of India's economy and is being least affected because of kind of lockdowns or local lockdowns as well. So their ability to kind of conduct business essentially is being way higher and less constrained versus their counterparts on the urban side. So clearly believe that the rural economy seems to be a relatively better place. And there are several exciting businesses across consumer, automobiles, financials, where with the advent of technology, they have been able to kind of reach out to the hinterlands of India or Bharat, as we may say. And therefore, these kind of businesses probably will exhibit stronger growth going forward. Even in the very short term, the monsoon forecast and then the forecast of a very normal monsoon has been very heartening. This is the third year in a row in which basically monsoons are going to be normal, and that bodes well for rural India. In addition to that, we've not yet seen agri-inflation to the extent that we've seen inflation for some of the other commodities like metals and a bit like crude. Yet the upward movement in prices of agri-commodities has been relatively quiet, but still believe that that's something which can also gain momentum. So I think on the whole, there are several tailwinds which will be supportive of a much more stronger and a buoyant rural economy.
Let's talk about where do you think, and you are a mid-cap specialist, which are the mid-cap names where you think 3 years out, 5 years out, there could be a 20% earnings growth? What happens to stock price, Nilesh, we both know that will be a function of sentiment and a lot of other factors. But we can perhaps try and understand our earnings. You mentioned Polycap and you mentioned Vector, the new IPO. Anything else which you acquired in your portfolio, let's say in last 3 months? Because if my memory serves me right, we've not discussed a name after Cipla.
Yeah, so we continue to, of course, like the pharma space, and we like businesses out there which are across the board, both large cap, mid cap in pharma space. So that's something which we like. But beyond pharma, what we essentially like are basically names like I mentioned about Polycap. In technology services, what we like is Birla Soft. That basically, as a company, has the ability to basically compound earnings at a higher rate because they have guided for margin expansion, and we think that can play out very well out there. Auto ancillaries is something which we continue to like. We clearly believe that the auto cycle still has got a long way to go. Even if basically their business activities or levels of FY18, FY19 get reached by FY23, that in itself would translate into double-digit earnings growth. So I think pharma, technology services, auto ancillaries, building materials, there are a whole bunch of businesses where we think that some of the mid-cap names could potentially be able to kind of have a double-digit earnings growth and do well over the medium term.
Where are you making space? So what happens to HDFC, AMC, ICICI, Lombard, some of the large cap stocks, even Engineers India, which you've traditionally liked?
Engineers India is something which we have basically exited, but basically ICICI, Lombard, HDFC, AMC, these are businesses which we continue to like, we continue to own them, and we think that they again present a very, very strong compounding opportunity for the very long term. Still continue to believe that mutual fund ownership in India is abysmally low. Still believe that penetration of general insurance, health insurance, again, is extremely low relative to some of the other emerging markets and some of the other developing markets. So clearly pockets of financial services, which is either mutual funds, general insurance, health insurance, life insurance, is something which we basically continue to like, and we continue to basically own them. And I think we honestly have a very long-term orientation towards these kind of businesses.
Interacting with you and getting an in-depth analysis as to what your outlook is on the markets, as well as portfolio allocation and where it is that you believe investors should be putting in their money.